How to invest $100. $100 doesn't sound like much, and to be honest, it really isn't. It's enough to pay your internet bill or your phone bill, or go out to a restaurant or on a dinner date. That's better than nothing, but it's not exactly what most people would call high finance. But with the right strategy, even a small investment can generate big rewards. To begin with, let's be honest about our goal. You're not going to retire on $100, so your first goal should be to turn that $100 into $1,000. After that, you want to turn the $1,000 into $10,000 and so on. The point being, if you're not growing your money, you may as well have spent that $100 instead of investing it. This leads to something you'll want to keep in mind throughout the course of this video: the balance between risk and reward. As a general rule, riskier investments tend to offer higher returns. If you aren't willing to take risks, your money will take forever to grow. On the other hand, if your investments are too risky, you can lose all your money. By striking a balance, you can sustainably grow your investments over time. And make no mistake, time is key. There is no such thing as a get-rich-quick scheme that works. If someone tells you that you can spend $100 today and immediately start earning thousands of dollars per week, run away. They're scamming you. Real investing takes time and patience. With that out of the way, here are 6 of the best ways to invest $100. The first way is to invest in physical objects and resell them. That's right, we're about to talk about flipping items. So what kind of items should you flip? The short answer is anything you're knowledgeable about. Think of your hobbies and work experience and let that be your guide. Let's say you used to play in a band, or you still do. You probably know a little bit about musical equipment. So head over to Craigslist, Facebook Marketplace, or another website and look at amp and instrument listings. You'll probably find some offerings that are priced way below market value. Maybe the owner needs the money badly, or maybe they're moving and want to unload their old junk. The point is to find something that's underpriced, buy it, and sell it again at market value. If you know what you're doing, you can pretty reliably earn a profit. I picked the example of musical equipment, but the same applies to any interest. You can make money flipping collectibles, old video games, and even some types of athletic equipment. Furniture is a great opportunity, since a lot of people sell it for cheap when they move. If you're lucky, you can even double your money. As a matter of fact, you can even flip items without investing any money. A lot of online marketplaces now offer a free section where people are giving things away. All you have to do is drive somewhere and pick up your items. If a resale covers the cost of gas, you've made a profit. The next way to invest $100 is to invest in an ETF. ETF is short for Exchange Traded Fund and refers to a number of different funds you can buy on the stock market. What makes an ETF different from a normal stock is that it's made up from a large number of stocks. Remember how we talked about balancing risk versus reward? Buying a single stock is a high-risk investment. The company may do very well and you might earn a big return. On the other hand, the company could have a bad year or even go out of business. In that case, your stock might be worth zero. With an ETF, you spread your risk across a number of different stocks. Some companies will do poorly and others will do well, but on average, the market as a whole tends to go up. For example, the S&P 500 is one of the oldest ETFs and has an average of about 10% growth per year throughout its history. Now, just because it's done this well in the past doesn't mean it's guaranteed to do the same thing in the future. But in the long term, the only way ETFs go down is if the entire US economy goes down. In that case, any individual stock would not save you. One issue you might have with investing in an ETF is that many of their shares cost more than $100. In that case, you won't be able to invest through a traditional brokerage. You'll need to set up an app that allows fractional trading. With fractional trading, you tell them how much you want to invest and they'll sell you a part of a share. So you could invest $100 in any fund, regardless of the current share price. Apps like M1 Finance and Webull are good examples of this kind of technology. So you've got your app, you invested your $100, and you watch it grow. What does 10% annual growth actually look like? If you invested $100, through the magic of compound interest, you would have $1,083 at the end of 25 years. There are a lot of assumptions built into that number, but it's an example of what compound interest can do. Now, let's say that in addition to your first $100, you invested an additional $100 every month. How much would that be worth after 25 years? As it turns out, you'd have over $119,000. That's not enough to retire on, but it's definitely a worthwhile nest egg. Again, though, we're not talking about getting rich quick. We're talking about setting a goal and sticking to it. Option number 3 is to invest in individual stocks. Now, I know we just talked about this being riskier than an ETF, but a lot depends on why you're investing $100 in the first place. If you need that $100 badly enough that you're worried about losing it, maybe individual stocks aren't right for you. But maybe you're investing your $100 for fun. Maybe it's extra money you have lying around and you want to see if you can make it grow. In that case, it can make sense to buy an individual stock. That said, just because you're investing in individual stocks doesn't mean you should put all your money into one company. If your trading platform supports fractional investing, that's certainly an option. But the wiser strategy is to diversify your investments by putting your money into different companies. This works in much the same way as an ETF does. One company might have a bad year, but you're betting that the majority of your investments will gain value. Along the same line, it is also important to invest in different sectors. If all your money is invested in the auto industry, for example, a single market shock can cause all your investments to lose value. The more diverse your investments are, the safer you'll be. Another reason you might want to invest in individual stocks is if you want to buy dividend stocks. Dividend stocks are companies that pay a portion of their profits back to their shareholders. This payout is called a dividend, and you can either take the money or reinvest it in more stock. Dividend stocks tend to be the older, more established companies that are no longer growing very quickly. Think of companies like GE and IBM, who dominate their respective markets but don't have much room to grow. Instead, they offer dividends to continue attracting investors. The fourth option might not sound like an investment at all, but why not invest in yourself? With new knowledge, skills, or tools, you can help yourself earn more money down the road. For example, let's say you have a side hustle doing web design. Why not spend $100 on an advertising campaign to attract new customers? Along the same lines, you could spend it on a class. Or let's say you're a mechanic. If some new tools would help you be more productive, $100 investment can pay off in saved time and effort. A $100 investment can even be something as simple as a website to promote your business. The fifth way to invest $100 isn't really a good idea at the moment, but I wanted to talk about it anyway because it's an option you're going to run into. This method is to invest your money in high-yield savings accounts. A high-yield savings account earns higher interest than ordinary savings or checking. So if you've got a lot of money just sitting in the bank, it can't hurt to put it in a high-yield account instead. That said, the highest-paying savings accounts are paying about 0.5% interest. If you invested $100 at that rate and it sat for 25 years, your money would be worth a whopping $113.31. Even if you invested another $100 every month, it would still only be worth $32,068.71. That might sound like a lot, but you would have invested a total of $30,000 of your own money to begin with. Ouch! High-yield savings accounts have their place. They're FDIC insured up to $250,000, so they're a safe place to keep your savings, and they pay better than other bank accounts. But the investment rates don't even keep up with inflation, so your money is actually losing value over time. Give these accounts a pass unless you have nothing better to do with your money. The sixth way to invest $100 is to put it into a retirement account. These accounts come in a variety of types such as 401ks, IRAs, and Roth IRAs. The different types have their own specific rules, but in general the money is tax deferred. This means you won't have to pay taxes on it until you retire, but you will pay a penalty if you withdraw it early. Another benefit of retirement savings is that many companies offer matching funds for their employees. Depending on your employer's rate, your $100 investment could be worth as much as $200 towards your eventual retirement. Don't forget, if you want to buy stocks or ETFs, you'll want to use an app that allows for fractional trading. Otherwise, you'll be limited to what you can buy for $100. As an added benefit, you'll be able to invest directly from your phone without having to go through a broker or pay extra fees. You can find links to the M1 Finance and Webull apps in the description for this video. Both are affiliate links that help the channel when you use them to sign up. Make sure to leave a like and click the subscribe button and the notification bell if you haven't already. Happy investing!